Happy Friday, everyone, and welcome to the 2026 CreditSights Global Strategy Outlook webinar. My name is Winnie Cisar, and I have the honor of leading the CreditSights Global Strategy team. Today, after truly a bizarre year and lots of strange moving pieces in the broader markets, we bring you yet another action-packed webinar featuring Zach Griffiths, the U.S. Head of Macro and Investment Grade Strategy, Logan Miller, Head of Euro Strategy, Regis Chatellier, Head of EM Sovereign Strategy, and Zerlina Zeng, Head of APAC Strategy. Now, this Outlook season, I would say, was extra complicated given the dearth of official U.S. government data from that record-breaking and not a good way government shutdown. Given that we have 1 hour and 5 speakers, we'll be going through the highlights of our outlooks. As a reminder, US and Asia outlooks were released yesterday, and we have EM Sovereign and Euro coming early next week, so look out for those. As always, if you have a question, please go ahead and submit it through the Q&A function, and we'll be doing our best to address as many as we can. I know that everyone has a lot of questions right now. We also, of course, have those emojis going. These are always a fun addition to the webinar. Keep them coming. Be kind to the strategy team. Outlook season is an especially brutal time of year. Zach and I actually subtitled the US Outlook Overweight Anxiety, so that gives you a little insight into our current mental health. Now, with that, as we like to do on the strategy team, we're going to turn the tables and ask the audience our first question. We've seen a little bit of gyration in Treasury yields as of late, and they've held above 4% on the 10-year in recent trading, though they're coming down a bit today, I think at around 407. Where do you think the 10-year Treasury ends 2026? You can go ahead and submit your votes. Is it below 3%? 3 to 3.5%, 3.5 to 4%, 4 to 4.5%, or some Treasury bears above 4.5%. We'll let the audience submit their votes, and then we're going to turn it to Zach to see what he thinks about the outlook for rates and macro in the US. Just going to give it another couple seconds or so. Lots of voters today. I appreciate that. It's your civic duty to vote in the CreditSights audience polls on our webinars. All right, I think we have a critical mass here, so let's see what the audience has to say. Okay, Zach, 3.5 to 4% with almost a majority, 49.6%. So, we can round. And then next, 4 to 4.5%. What do you think about, Zach? Is this kind of in line with your expectations?
This is a little more bearish than our expectations, Winnie, but I'd say it's consistent with the consensus and what forwards are pricing right now. So our base case is a little bit lower in yield. I know we'll get into that in a little bit more detail, but interesting to see kind of where that shook out. So I guess going with our outlook in terms of economic growth for this year, we are looking for economic growth to slow below potential and below what the consensus is expecting. So we have US GDP coming in the 1 to 1.5% range in 2026, a more notable downshift than what many are expecting. We think that's going to be driven by the consumer. The key driver there is the labor market, which we've seen signs of weakening. I'd say yesterday's payrolls report for September, certainly even more backward looking given that government shutdown, was interesting, but the market seems to be taking it as a little bit more of a negative in terms of that 4,000 job losses in August following the revisions relative to the upside surprise on the non-farm payrolls itself. So we are looking for the labor market to weaken a bit further. We have a below consensus US GDP call. And the one thing I'll point out on this slide is the middle chart looking at cash balances of US households by income quintile. What you can see here is the bottom 20% or the bottom quintile have essentially seen flat cash balances since pre-pandemic, while consumer prices, the dotted line, has risen about 25%. So we've seen a dramatic loss in purchasing power of cash reserves for the lowest income. And so you can kind of see that the rest of the distribution has held up a little bit better. But we think that with actual job losses coming in several months and weak job gains in aggregate, in 2026, we think some of these fragilities at the lower income cohorts start to have a broader impact on the economy. The other thing I'd point out on this slide is looking at the chart on the right. US real personal consumption expenditure is still running about 2.4 percentage points above the pre-COVID trend. We think that that is ripe for a return back toward that trend line, especially in this weaker labor market environment that we expect in 2026.
So, with that kind of weaker labor outlook that we've heard some Fed officials lately have a little bit of a different message. Some are saying that we are content to sit on hold right now. We're in a good place. Although our main man, John Williams of the New York Fed this morning, kind of came out and said that a near term rate cut could be appropriate. Zach, what do you really think the Fed officials are going to do? Are they actually content to wait and see and skip that December meeting for a cut? We've seen cut expectations go from just 6 basis points in December yesterday to now 17 today. And then how does that path of policy evolve over 2026?
So, looking at what we saw in the FOMC meeting minutes, when we would still put a December rate cut on the table. That is our base case. And when I read through what policymakers were thinking back in October, we still give the edge to a weakening labor market in terms of the top concern, although we have heard from several more hawkish Fed policymakers recently citing their inflation concerns. So ultimately, we are expecting the Fed to cut rates in December, but we're going to be more focused on the forward guidance as key in terms of what drives the market reaction. Even if we get a hold, what the Fed indicates it plans to continue easing further, I think you could get a rally in rates, maybe even a rally in risk sentiment. But if you get a cut and an indication that they're done there, as they now see the balance of risk to inflation and employment as more or less in balance, and I think that's kind of a bearish, or yields could rise on the back of that. And so we're going to be more focused on the forward guidance relative to the actual policy move in December. And in terms of how that fits with what we're expecting for 2026, we're calling for 3 more cuts to take the upper end of the Fed funds target range to 3%. But I'd say what's really different about our call relative to consensus is we think the terminal rate in this cycle could be more like 2.5% and expect the market to be pricing that by the end of next year. And so we have the curve steepening to 100 basis points for 2s, 10s. We have the 2-year around 2.5%, the 10-year around 3.5%. And as you can see in the chart all the way to the right, we are certainly lower in yield and steeper in curve than what the forwards indicate and what the consensus call is. If you look at our probability weighted forecast, we're a little bit more in line with kind of what you see in those yield curves. The other thing I'd point out is clearly the market is a little bit more concerned about the curve bear steepening or remaining steeper through that very long end, as you can see with the light blue dotted line. So that's certainly a risk to our call, but I think in our slower growth environment, more aggressive Fed cutting, you're going to see yields lower across the curve with that steepening at the 2s, 10s point. Last point I'll make in terms of our rates outlook is our 10-year Treasury fair value estimate is still at 3.75%. So indicates some room for a move lower in yield now. And we ultimately think that the reset and pricing for the path of the Fed, consistent with our calls, kind of brings that fair value estimate even lower. That's how we get to our 3.5% call. In terms of the breakdown between real yield and break evens, we could see real yields falling into the 1 to 1.25 range, with break evens more or less steady at 2.25 to 2.5%. So we're really looking for real yields to do the heavy lifting, bringing that nominal yield lower in 2026, Winnie.
All right, so lower in the near term is the view on the rate side of things, with the Fed cutting a little bit more aggressively than what the market's currently pricing in. So Logan, I would love to bring you in here to talk a little bit about Europe, because the ECB has been ahead of the Fed. It seems like the market expects that the ECB is basically at its terminal rate for this cycle. Do you agree with this view? And how do you think the macro factors are evolving in the Eurozone? Do you think that the region is kind of set to catch up a bit to the US in terms of growth, or are the paths going to remain a bit more diverged?
Yeah, when you mentioned, this outlook was definitely quite complicated. I think our views definitely differ quite a bit from, what Zach was just alluding to in terms of kind of his expectations for the Fed and for rates. I do think that the ECB is done in terms of kind of the cutting cycle. The ECB was was quite proactive in terms of cutting rates kind of from mid 2024 through the first half of this year. And now I think I think the ECB is now going to be in sort of wait and see mode. Now, as it relates to markets, I think one lesson that I've learned this year, I think the markets learned as well, is don't fight central banks, and in the case of Europe, don't fight the ECB. I think from a technical standpoint, the rotation from cash into high quality fixed income really has been a major tailwind for credit so far this year. It's been fueled by that proactive sort of rate cutting we've seen, and it's helped fundamentals. So I think fundamentally coming into this year, European companies were fortunate to have entered from a point of strength. And I think the biggest surprise to me really is that despite some of these headwinds to earnings, particularly as it relates to tariffs on some of the more export driven sectors, margins have actually been generally resilient, with obviously some exceptions like autos, but more importantly, I think forward growth expectations, both for earnings but also for economic growth, are positive going into 2026. So the economic outlook I think looks pretty good. The earnings backdrop I think should be able to continue holding there. Now, when you ask kind of the path for ECB rates, again, I think the answer to that is they're going to be in wait and see mode. One of the key things I'm watching next year, I think the market's also looking at pretty closely, is really around German fiscal spending, particularly sort of the multiplier effect of that fiscal spending on the broader economy. Germany has clearly been a major laggard in terms of economic output over the last several years. And so I think now they've got sort of this potential tailwind going forward. I think that being said, it's really interesting if you look at where consensus GDP forecasts for Germany are next year. They haven't really moved all that much since the beginning of the year, despite this big kind of fiscal and debt pivot by the German government. And I think more importantly for fixed income investors is that a lot of this fiscal stimulus that's planned will need to be financed in large part via the bond market. So I think that puts upward pressure on yields, which again is a bit of an opposite expectation to what Zach was talking about when it comes to long dated treasuries. So I think that convergence story between European long end yields versus U.S. treasury yields is going to be a kind of a key theme as we get into next year. The other consideration, I think, is sort of the economic impact of fiscal expansion on inflation. I do think that fiscal stimulus is looked at as being, likely to be counter-cyclical and thus kind of meant to stimulate a pretty weak economy rather than pro-cyclical, that stimulus that tends to sort of heat up an already, hot economy like you're seeing sort of in terms of U.S. policies. So, in terms of the inflation outlook, I think that too much of a good thing can be a bad thing. If we get too much stimulus all at once, I think that does probably lead to higher inflation over the long run for Europe. Conversely, I think if it's kind of slow and methodical, then I think this kind of fiscal spending impulse could actually be pretty positive for growth without really kind of reigniting inflation, which I think is what the ECB is also hoping for, and which also I think the market's expecting. Hence why I think forwards are pricing in basically unchanged rates over the next 12 months for Europe. Last thing I just mentioned is, I guess where what could really throw things off, this kind of status quo view towards the ECB. I think one, there's obviously no guarantee that government spending is going to really boost private consumption across Europe. I think it definitely has the potential to, but really depends on how this money gets spent and sort of where it gets spent. Also, the political environment across Europe remains, I'd say pretty delicate. Even in Germany, where the government is effectively a blank check now, there's a lot of cooks in the kitchen in terms of determining where this money goes, and still some red tape around getting that money to where it needs to be. And then the last thing I mentioned is given sort of your more bearish views on the U.S., I think that's certainly something to consider for Europe. I don't think that Europe can really grow it alone. I think maybe on a relative basis, Europe may come out stronger if the U.S. really goes into sort of a material slowdown, or less bad, I should say, for Europe. But the U.S. is still Europe's largest trading partner and largest consumer. So I think no doubt that if we do see slowdown across the pond, it's going to have some negative implications for Europe.
Yeah, absolutely. A lot of moving pieces there. And I think that the point around fiscal and inflation is a really interesting one. It also applies to the US, as we still have the One Big Beautiful Bill Act and potential bump up in some tax rebates. Is that going to do a little bit of a head fake higher on inflation in the US? And then, how does the fiscal picture evolve in Europe as well? So, Regis, I'd love to go to EM next. EM has generally done pretty well this year. I would say that maybe that's a surprising development given the mix of policy coming out of the US. What's your expectation for growth in 2026 across EMs, and which countries are you really focused on as particularly strong or particularly weak?
Yes, indeed. Emerging markets have been quite resilient this year despite a lot of headwinds. Obviously, particular the uncertainties around the US tariffs, but that's probably one of the lessons learned in 2025. The EM macro fundamentals are more robust than the past, and that's due to strong domestic demand. I would say resilient commodity exports, and I would say better fiscal discipline than developed markets across the board. So just to give you a number, I think it's quite interesting. So far this year, we had nearly 30 EM countries that have been upgraded by at least one of the rating agencies, and only 7 downgrades. Just to give some names: India, Saudi Arabia, Turkey, Egypt, Morocco, Oman, South Africa, Nigeria. Just to name like the main ones. And on the downside, on the downgrade side, only Colombia as the main one was downgraded. Otherwise, it's been a pretty seamless stream of upgrades. And EM Sovereign Credit Index is now solidly anchored in the triple B minus category. Now, regarding economic performance, EM GDP growth is expected to be around 3.9%, close to 4%. And that's up from 3.7% in 25. So that's a significant rebound. And that's going to be driven by less geopolitical uncertainties and still easing inflation, boosting investment and consumption. Now, more in detail, where I see growth, just to as far as China is concerned, China is expected to decelerate, probably less than predicted by consensus, but I will leave my colleague Zerlina to give more details on that. Otherwise, elsewhere in Southeast Asia, growth will continue to be quite strong. Philippines is expected to be around 5.7%, Indonesia 4.9%. They still benefit from pretty strong domestic demand and infrastructure spending, so this is going to continue. Outside Asia, several EM countries are set for significant rebound. For example, Egypt is expected to grow by 4.5%, driven by pretty strong foreign investment. Countries like Nigeria, for a long time, was not growing whatsoever. It's expected at 4.2%, Turkey 3.7%. So that's a kind of a nice surprise for this kind of region. GCC countries are projected to average 4.4%. That's a pretty sizable, significant increase. That's an improvement from 3.3% because of higher oil production, but also because of expansion of non-oil sectors. In contrast, we have economic activity a bit subdued in Latin America, apart from Argentina, where GDP growth is expected at 4% also. But if you take Brazil, Brazil is expected to slow to 2% because of fiscal consolidation and the 50% tariffs that has been imposed on Brazilian exports. Mexico could improve a bit, rising to 1.5%, but it's still quite subdued growth performance. Eastern Europe also a bit subdued, even though I think it could improve in Hungary and Romania. Essentially, Hungary basically a fiscal stimulus, and Romania because we come from a very low base. and Africa is still growing pretty strongly. So overall, EM economy will continue to outperform advanced economies. If we keep in mind, US growing a bit more than 2% maybe, and Eurozone a bit more than 1%. So EM still ahead of developed markets and is likely to continue.
All right. So EM still coming out ahead. Zerlina, I think that Asia is another region that has fared better than expectations, especially with all the trade and tariff headlines. Regis mentioned the outlook for China macro. How are you thinking about that? And then what other APAC region countries should we be watching for 2026?
Yeah, thanks, Winnie. As Regis mentioned, growth in Asia is indeed held strong this year thanks to a lot of proactive monetary easing, large fiscal stimulus, and increased intra-regional trade, which mitigated U.S. tariff headwinds. For China, we think China will comfortably achieve the government's around 5% growth target this year, which was ahead of our already above consensus forecast because policy support boosted retail and manufacturing investment, and that offset the prolonged property downturn. The momentum slowed over the past couple of months, but CPI and PPI deflation are turning around. I think this is indicating the underlying strength in the domestic demand. We are watching out for the Politburo meeting in December, which will set a lot of macro policy directions for next year. We expect additional demand-side stimulus towards consumption, social security, technology, and high-end manufacturing. We also expect policymakers to front-load a lot of next year's government bond issuance quota and roll out additional 10 to 20 basis points of policy cuts to sustain the growth momentum. Any incremental support towards the property sector would likely support China risk assets. So this includes Chinese equities, commodities, and high-yield China dollar bonds. In the rest of APAC region, we also expect macro conditions to remain quite supportive, but we are cautious about a few risks. First is the policy rate easing cycle is likely coming to an end in many Asian markets after the aggressive rate cuts this year. The market has already repriced rate cut expectations a bit lower in Australia, South Korea, Philippines, and any USD dollar strength would further deter Asian central banks from cutting, which was already flagged by the Bank of Indonesia this week. So as a result, we think fiscal policies have to do a lot more heavy lifting in 2026, and fiscal and supply risks are increasing in markets such as Indonesia, South Korea, and Japan. Japan's cabinet this morning just approved the new government's economic package with a supplementary budget close to almost 3% of GDP. But I think overall, fiscal concerns in Asian markets are still not as acute as most of the DM markets. And other than this, political unrests are still an ongoing concern in many Asian markets, such as Thailand, Philippines, and Mongolia. And from time to time, this will dampen the risk sentiment in the region.
Great. Thank you, Zerlina. All right. So let's move on to our next audience question, which is focused on U.S. investment grade spreads. Now, after hitting a cyclical tight earlier in the year, they've widened out a little bit to just north of 80 basis points using the BAML ICE indices, which is what we use. Where do you expect IG spreads are going to end 2026? Are they going to retrace lower than 80 basis points, 80 to 100, 100 to 120, 120 to 150, or more than 150, that danger zone for IG spreads? Now, as people are voting, we have an audience question, which I think fits in with some of the conversation that Zerlina introduced around the fiscal side of things, and then also what Zach was talking about in terms of rates going lower, saying that new stimulus has been announced by Japan, which includes more debt issuance and is likely to cause rates to drift a bit higher. Zach, I'd go to you first. Do you think increasing Japanese rates are going to limit or impact the ability for the Fed to drag US rates a bit lower?
I don't think those policies necessarily preclude a move lower in rates in the US, Winnie. I do think it is a key risk to our call for lower yields. In the US, the fiscal picture globally, as Regis alluded to in developed markets, has worsened and at various times been a larger and smaller mover of markets. I'd say in general, focus has been more on the UK, France, and now to maybe a somewhat lesser extent, Japan. So overall, no, we do think rates can move lower in the US, especially if the Fed is more aggressive the way that we anticipate. The Bank of Japan is still considering rate hikes at this point, but the global fiscal picture is definitely at risk of just how low yields can go in the US.
Great. Thanks, Zach. All right, let's see what our audience thinks about US IG spreads. Okay, so I would say we have an expectation for effectively range-bound spreads in US IG with 80 to 100 basis points representing just over the majority. I think that aligns with kind of the broad-based rate expectation of holding in that 4 to 4.5% area. Then we have another third who expects that IG spreads are going to go to 100 to 120. Very few Uber bulls at 5%, sub 80, and then not as many bearish people, about 10% of the audience over 120 basis points. So, Zach, let's bring you in. Outlook for USIG corporate credit. Audience expects spreads to be, I would say, largely range bound. Do you agree with that audience view?
We are not in the range bound camp. Winnie, maybe we can stay range bound for another couple of months at least, but we're expecting spreads to widen to 120 basis points in investment grade by year end 26. And there are two core things I'd say driving that call. One is our slower than consensus economic growth call, looking for really the labor market and some of the weaker parts of US households to broaden out. I think if we see financial markets hit a little bit more of a headwind in terms of pricing and expectations there, we could have a little bit of a reverse wealth effect that kind of counteracts what's really been driving the economy so far. We also think a weaker consumer and delayed tariff pressure will drive margin compression. But even if the US economy performs in line with what the consensus is expecting, a little better than we expect, I think some of this pickup in M&A, re-leveraging trends, and importantly, IG tech issuance as we're shifting to more of this AI CapEx being a debt-driven thing versus free cash flow financed operations. I think that becomes really not only a headwind for the IG tech sector as we have an underweight on IG tech, but can be a broader market shift in the technicals that have been very strong. I'd say the key risk is with so much cash in money market mutual funds, we are expecting them to produce around 239 billion of interest in 2026. That's down 22% from what we've seen in 2025. So we are looking for a fading technical tailwind on the demand side to meet kind of a more major uptick in the supply side, and that to move spreads back toward a more typically normal credit risk compensation level.
All right, so with expectations for a little bit of a wider spread call, what do we do in IG portfolios? Is there a way to still perform? Is there anything that looks particularly attractive or at least more fairly valued at this point?
Yeah, Winnie, so we like moving up in quality and just thinking about it from an excess return perspective, where we like owning single A's, which look historically cheap, versus triple B's that look very rich. So kind of looking for a mean reversion or spread decompression trade. We'd also apply that to duration from an excess return perspective. The 3 to 5 year space looks particularly cheap and attractive to us, while we kind of rather avoid the very long end of the curve from an excess return perspective. So I think kind of sticking in that 3 to 5 years is maybe the sweet spot. But from a total return perspective, with our lower yield call, I think we are more comfortable with, let's say, a barbell approach, kind of like in the front end of the curve as we're looking for a larger yield move there. But we also like moving out to the 10 years. As I noted, our 10-year yield target is 3.5%. If we're kind of moving lower in yield, especially with that longer duration, that's kind of a nice pickup in performance there. So that's how we're thinking about positioning from a ratings and curve perspective and an excess return versus total return standpoint.
Super helpful, Zach. So within the high yield and broadly syndicated loan space in the US, it's been, I would say, a little bit of a weird year. 2025 high yield total returns year to date are at about 6.9%, actually lagging those of investment grade because of the duration move, and also a little bit ahead of coupon levels. So I think that a lot of high yield fund managers are viewing it as a pretty okay year overall for high yield. But the distribution of performance has definitely skewed higher in quality. We have those longer duration double Bs posting the strongest year-to-date performance at 7.6%, and then triple Cs lagging pretty significantly at 5.4%. I would say perhaps even more notably, the distressed market has materially underperformed, generating return losses of 7.2% this year. And then at the same time, loans have generally lagged high yield, though they did make up a little bit of lost ground in November, bringing year-to-date returns to around 5% for the BSL market. Now, in recent weeks, we've seen technicals shift a little bit as the seemingly relentless inflows into LevFin observed post-Liberation Day have relented. High yield outflows have been over 6 billion over the past month, and broadly syndicated loan outflows have been about 1.5 billion. I think that softening in technicals is largely a function of a more cautious outlook for credit risk, as those recent high-profile blowups from Tricolor and First Brands have added to the confusing economic outlook, and then that hawkish tilt from some of the Fed officials is weighing a bit on appetite for LevFin, which has really been hoping for lower rates to help with some of the borrowing cost headwind. When we think about those headwinds, they've left valuations seeming a little bit less rich. High yield spreads are around 317 basis points. That's almost 60 basis points wide of the intra-year tight. And yields are back to around 7%, which is historically a better entry point for total return investors. Similarly, broadly syndicated loan prices have moved lower in recent weeks, back below 96, with a significant drop off in triple Cs. Now, as I noted in our preliminary outlook webinar, which feels like it was just yesterday, we maintain our concerns around lower rated fundamentals and see potential for fallen angel downgrades to meaningfully outpace rising star upgrades. Our CreditSights potential fallen angel list for 2026 totals 25 billion in bonds outstanding from 6 issuers, and the rising star list is down to a mere 3 companies with 12.2 billion outstanding. We also know that the skew of ratings outlooks and watches is decidedly negative for corporates in the triple B and double B cohort, while Bs are actually a little bit more evenly balanced. So for 2026, what do we do in LevFin? We think that there's going to be a continuation of some of the recent trends, including decompression across the credit curve, intentional releveraging, and event risk, both positive and negative. With this, we're really focused on sector strategy, which has proven a crucial discipline in 2025 as the best performing sector. Telecom has generated year-to-date total returns of 10.6%. Major shout out to Davis A. Bear, our head of TMT and high yield / telecom and media analyst, who went overweight high yield telecom with our 2025 outlook. We're taking some chips off the table in that call and downgrading the sector to market perform, as a lot of those positive event risk catalysts have indeed been realized. At the other end of the sector performance heap, transportation has posted the weakest returns in high yield this year in barely positive territory at plus 25 basis points. Our high yield transport analyst, Matt Woodruff, has been cautious on airlines, which do make up a bulk of that high yield transportation index, and he is maintaining his underperform recommendation on the sector. Some other notable sector calls for 2025 include downgrading both high yield energy and leisure to underperform from market perform. We think that potential for weaker crude prices could pressure high yield energy names as investors sell first and ask questions later in a sector that has proven a bit problematic over the past decade. Our leisure call is predicated both on technical headwinds from Carnival as it moves to investment grade in the first half of 2026, and then a weaker gaming outlook for both regionals and Vegas. I think maybe a strategy due diligence trip is in order. Our upgrades to outperform in high yield include media, which looks a lot like telecom did this time last year, with potential for positive event risk and wide valuations. And we also upgraded high yield technology as it trades wide to the index, with continued upgrade momentum in large issuers, and the repricing of Xerox has already moved it into deeply distressed territory. Within the broadly syndicated loan market, we do reiterate our underweight allocation as we see continued challenges for the market and worry that the robust liquidity provided by private credit funds might start to feel a little bit less flush amid pressure on BDC equities, dividend cuts, and questions about credit quality within private credit portfolios. Our base case forecast envisions Two key negative catalysts for the BSL market. First, falling base rates cap total returns, while credit concerns from a weaker labor market, rising downgrades, and an uptick in defaults pressures prices lower and spreads wider, weighing on total returns. Across LevFin as a whole, we have a preference for US high yield over the broadly syndicated loans, with a focus on double Bs and select single Bs with positive event risk or fundamental catalysts. When we look at market implied forward defaults, they've ticked a little bit higher in recent weeks as spread decompression in high yield indicates a 4.3% forward default rate. That's up about 50 basis points from the year-to-date average level. So still some places to go in the world of LevFin, but feeling a little bit picked over in general. All right, let's go to our next audience polling question, which is looking at US asset class total returns. Which US asset class do you expect to generate the strongest total return performance over the next 12 months? Is it cash, long-dated US Treasuries, US IG, US high yield, broadly syndicated loans, mortgage-backed securities, gold, or do the crypto bros make a comeback? Zach and I were discussing this morning. There are some forecasts that Bitcoin's going to 200K in January, which would represent a pretty nice, very short-term return opportunity. So I would love to see what the audience has to say. Zach, while the audience is voting, we have a question on debt to fund AI. Over 100 billion in publicly offered debt for AI has recently come to market. More is forecast to be needed by the hyperscalers in 2026. That's exactly right. Our tech team has been all over that. Where do you think that kind of supply impacts the IG and high yield markets? Zach, I'd love to hear your take on IG first.
Yeah, Winnie, as I mentioned earlier, that's a really core to our call for an underweight recommendation where we think spreads could widen. Just to put some numbers around it, Jordan Chalfin, our tech analyst, has an estimated 443 billion of annual hyperscaler capex this year, expected to go up to 600 billion next year. And I think the poster child for debt issuance to finance this right now is Oracle. Just came with an $18 billion deal. He expects them to come with 85 billion. I think not in addition to that 17, but in aggregate over the next 2 to 3 fiscal years. So we do think it's going to be an overhang for the market from a supply perspective, and kind of keeps focus on fundamentals that should be moving in the wrong direction next year.
Yeah, absolutely. I think that net headwind from net new issue supply related to AI and CapEx is definitely something that we are going to see in the investment grade market. In the high yield market, I think that a lot of that supply is actually being filtered into the world of private credit and the ABS markets. But in general, we are seeing kind of a renewed focus on some of those net uses of supply with an uptick in LBO announcements. We expect that high yield supply is actually going to be a little bit slower next year as falling base rates actually push a lot of issuers into the broadly syndicated loan market over the high yield market. That's one of the reasons that we're a little bit cautious on loans overall. We think that technicals could be a little bit skewed there as well. All right, let's see what our audience thinks about the strongest US asset class in 2026. All right, we're all over the map, though US high yield gets almost a quarter of the votes at 23%. That would be followed by a tie between gold and crypto. That's kind of wild at about 17% each. And then US investment grade. No love for broadly syndicated loans or MBS, and about 6% of the audience is looking for cash to be the top performer. All right, Logan, let's bring you in to talk a little bit about Euro IG and high yield recommendations. How have your thoughts evolved for Euro asset classes for 2026? Do you still think that Euro high yield is in good shape to outperform, or should investors start to move a bit more up in quality?
Yeah, thanks, Ray. Yeah, I think there are definitely some arguments to be made about lightening up risk heading into 2026, just considering where spreads are currently trading relative to kind of historical tights, pretty much near or at the tights from that standpoint. At the same time, I think credit investors are grappling with where else to go to generate, pretty decent yield income that corporates still offer. So, if you look at where we're now sort of in Europe talking about, policy rates being somewhat loose, nominal policy rates are now back below kind of annualized inflation figures, which I think is quite interesting, sort of an opposite trend is what we're seeing from the US. And so, while the compensation for European credit risk is low based on spreads, I think there's also, a case to be made that investors are not being compensated enough to not take risk, and basically moving into sovereign bonds. I think it's not quite a compelling trade right now. I think you can also you can buy French oats at sort of a similar spread to Boons compared to Euro IG spreads, but I don't love that trade. Just considering sort of the political drag in France, and sort of inability to cut depth and spending. So we're not cutting risk. In fact, we are raising our recommendation to Euro IG to market weight from an underweight. And I think really this is from we're taking the view that Euro IG has become a relatively defensive play on a global basis, both from a duration and credit risk standpoint. A lot of the risks that you and Zach have talked about aren't necessarily factors in the European markets right now, particularly as it relates to sort of more material labor market weakness. We're not really seeing that transpire as much on the European side. So I think the economic backdrop is holding in quite well. I think at this point, we're not looking for, material spread tightening from here. I do think that, we're going to continue to see sort of a grind wider over the next 12 months. But really, our view is that sustained spread widening should be limited. Still a lot of cash on the sidelines that needs to get deployed. And I mentioned, just sort of a lack of alternative, places to put that money to work within European markets. Let me just talk about our forecasts for a quick moment. I think I mentioned earlier, but I do think, the ECB is probably stuck in neutral. That being said, I do think there's some upside in terms of long-term sovereign yields in Europe. My expectation is obviously that we're going to see some pretty hefty fiscal stimulus and fiscal borrowing in Germany. I do think as sort of base rates have come down, you're going to start to see a deceleration of inflows into fixed income in general, and then you have a potential vol around kind of Dutch pension selling at the end of the year and throughout 2026. I think that puts some upward pressure on Boons. So we're expecting Boons to basically kind of trade in this sort of sideways range, or slightly higher over the course of next year. And then on the IG side, like I mentioned, spreads we expect it to move a little bit wider from here. Really, I think the view there is that fundamentals have been slowly deteriorating from a creditor standpoint. Meaning that companies are actually seeing leverage tick higher, and debt growth has been outpacing earnings growth so far this year. So I think that in general, spreads need to reflect that fundamental deterioration. So sticking with a market weight on Euro, or moving to a market weight on Euro IG, we're also sticking with a market weight on high yield. We've actually been quite favorable on high yield over IG throughout most of this year. I think it's difficult where yields are at to really get too negative on the asset class. At the same time, our total return forecast for next year is kind of below coupon. So, I think sort of a market weight allocation and sort of an up in quality strategy within the high yield market still makes sense going into next year. And then finally, just on the UK side, I think there's been on a lot of I think bad news on the fiscal front priced into gilt yields. At some point, I do think that investors can't really ignore the carry proposition that's being offered by sterling fixed income. So we would be looking to be buyers of continued gilt volatility around the upcoming budget on the 26th of November. But spreads are just too tight, and so we're remaining underweight on sterling IG from a excess return standpoint.
Great. Thanks, Logan. Real quick, any Euro sectors that you think are really interesting, positive, negative, quick takes?
Yeah, sure. Just quick on that. So I think we do like adding a little bit of cyclicality to portfolios via European autos. We've kept that as an overweight. To be fair, that kind of the fundamental outlook still remains challenging there. But I think that there's still quite a good risk reward proposition from where spreads are currently trading. If you're willing to sort of look through the volatility. On sort of a more defensive side of the spectrum, we like European utilities for high quality duration. Spreads relative to the index within senior utilities are basically at the widest levels of the cycle, and we think that sector's insulated from trade headwinds. And then on the flip side, we moved to an underweight on European basics, and this really reflects kind of a heavy concentration of chemical issuers. We're also underweight at the subsector level. We're definitely starting to see some pronounced weakness in the high yield chem space, with sort of a worsening macro conditions and sort of weak global demand. We think this could eventually roll up to the IG universe, where you start to see event risk become more pronounced, and we don't think that's being priced into spreads. Um, and then just the last one, we maintained our sort of underweight call on both consumer goods and retail. From a relative value standpoint, also, we're starting to see a pickup in M&A releveraging activity, and shareholder returns are sort of back on the mend within that space.
Awesome. Thanks so much, Logan. All right, Regis, let's go to EM next. Is EM set to post another strong year of returns? It's been a top performer this year. And then how are you thinking about that risk and reward across EM sovereigns in IG and high yield?
Yes, EM bonds have strongly outperformed this year. That's particularly true for EM local bonds. I mean, they're up by nearly 15% year to date, as they could benefit from weaker dollar and rate cuts. But that's also true for sovereign high yield bonds, and that's truly dollar exposure. They're up by nearly 14%, and that's the third consecutive year with this kind of performance in EM high yield. So really, really strong performance over the last 3 years, including 25. Meanwhile, sovereign high G bonds are up by approximately 10%, thanks to lower U.S. Treasury yield, but also decent spread compression. So a very strong year again. However, EM bonds are largely outperform other fixed income asset classes, and we may see less rating upgrades in 26 than this year. So I guess a lot has been priced in already. There has been improvement in fundamentals, but in fact, if you look at the balance of a potential upgrade versus potential downgrade, we are pretty even now. So we're going to be stuck at sort of a triple B minus sort of rating for the asset class. But beyond that, spread variations are very tight, as you could see in this graph on the charts. EMIG trade at an average spread of 85 basis points. EM high yield 320 or so. Overall, we are the tightest level since 2027, right? So more than nearly 20 years ago. Valuations are much tighter than what global financial conditions and commodity prices would suggest. You can see that on the right-hand side of this slide. In fact, you can argue that current spread valuations are justified only if you consider that US risk is hardly better than EM, which remains a bit of a stretch at this point, I guess, for most of us. Now, how do I see EM performance next year? I think EM local bonds could still have upside in the scenario of dollar weakness. Some countries are likely to cut rates quite aggressively, especially Brazil. The very high policy rates are now. Colombia potentially as well, Mexico, and in Asia, potentially India as well, as inflation has come down. I don't see much excess return coming from sovereign IG. It's very, very tight. And total return would be basically driven by US Treasuries. So I don't see much upside here. I stick to underperform view. Sovereign high yield fundamentals are strengthened, as I mentioned before, especially countries like Argentina or Turkey, Nigeria, Egypt to some degree. But again, valuations are quite tight, and I don't see much value apart from carry. So overall, EM fundamentals are stronger, but I think the risk reward on EM bonds is not very appealing. I would stick to underweight position here, not because fundamentals are weak, but because valuations are probably too tight. I would expect the spread between EM high yield and EMIG to widen quite significantly by the end of the year, probably going back to 400 basis points from 240 at the moment. So this is what I see for EM going forward.
All right, still a bit of a cautious outlook from a RelVal perspective for EM, though fundamentals hanging in there. All right, Zerlina, let's go to APAC. Asia dollar, IG, and high yield have really outperformed the US this year, but spreads are now trading well inside US markets. Is this trade set to reverse? Should investors instead focus on local currency markets? Where are we to go in the APAC region?
Yeah, we still see a good chance for Asia dollar IG and high yields to continue trading inside US peers under our base and bull cases. I think most of the supporting factors for Asia dollar credits will likely sustain in 2026, including this benign macro and good local funding conditions in most EM markets, quite strong corporate fundamentals, relatively low default rate and distressed ratios, and very strong technicals from continued net negative supply, which we forecast at 20 billion next year. Spread compression opportunities are very limited in Asia extra bank credit space, given the razor-thin spreads. Front-end carry is still our preferred strategy for excess return mandates. For total return mandates, we see good value positioning long-dated and high-grade Asia credits as a duration play. And we also encourage investors in Asia to look at off-index positions in Japan, Australia, and the Middle East, where strong news shoes and good spread pickup will continue attracting fund inflows. This year, Asia local currency bonds are a hot topic. Asia local currency bonds funds see a robust inflow of more than 20% of the year start AUM as investors look to diversify currency exposure away from USD and ride the rate easing cycle in EM Asia. We had recommended positioning Australian dollar, Sing dollar, and CNH bonds, which played out quite well this year. So looking into next year, we think Asia local currency bonds still have some lags given the continued interest and inflow from regional real money accounts and also the improved depth in the primary and secondary markets. But we think Asia rates and FX volatility are likely going to pick up, so this may potentially erode the total returns.
Great. Thank you so much, Zerlina. So let's go to the audience again for their preference from a market region perspective. Which bond market will generate the strongest total returns in 2026? Treasuries in the US, US corporates, German bonds, European corporates, EM sovereigns, or Asia corporates. Everyone can go ahead and vote. I'm going to address a couple of questions from the audience. We've had some requests to share slides on US credit spreads. We will be sending out the slides to all the attendees after the webinar, so just look out for that in your inbox. Zach, we did have a question on IEEPA tariffs. This is something that you have devoted a lot of your mental energy to this year. So if Trump loses on IEEPA tariffs at the Supreme Court, recall that there were oral arguments at the beginning of November. We're expecting to see a decision on that perhaps in January and February. And, if he loses and there's a refund needed to corporates, how big of a boost to corporate earnings is that going to be? And then how do you think that it might be implemented? Credits, refunds? What do you think?
So looking at what we've collected in tariffs this year and how that compares to recent norms, I'd say there's probably been about 75 billion that could be subject to refund, Winnie. And I'd say our base case at CreditSights is these tariffs are struck down or ruled against by the Supreme Court. But ultimately, while that is certainly a huge tailwind to fundamentals of transfer of cash from public to private, I think that the idea of more tariff uncertainty or renewed tariff uncertainty, assuming that the administration tries to re-implement these tariffs through various other statutes, might be the bigger story and more of a net negative in terms of the uncertainty, volatility, and inability to plan for corporates. So we're not necessarily thinking it's going to be a huge tailwind, even if it comes to fruition, as we think there's more uncertainty driven, and that's kind of a paralyzing impact.
Great. Thank you, Zach. That's been something that we've been hotly debating here in the Charlotte office. All right, let's see what the audience thinks for the top performer All right, we got a bunch of U.S. corporate stands in the House, with U.S. corporates taking 41.6% share. That aligns with the high yield expectations. After that, we still have some EM sovereign believers at 21%. Then Euro corporates just narrowly edging out U.S. Treasuries, Asia, and German bunds bottom. All right, so we're going to wrap this up with a quick speed round to actually audience questions, and that is team strategy. What are you putting on your bingo card for 2026? That is, what is something that might happen that maybe the market's not expecting, or something that you just kind of have top of mind? Zach, let's go to you first.
Scott Bessent as Fed Chair 2026.
I love it. Scott Bessent as Fed Chair. Regis, what is on your 2026 bingo card?
Well, in fact, there's a lot of things going on, a lot of political developments with elections. In Hungary, we have general elections. Viktor Orban is trading in the position. So I think we can have a regime change. So it could be something to watch. Colombia presidential election as well. A lot of expectations. Peru, also elections in March. I wrote recently about that. I think you could have more political stability and return of inflows. Chile, there was general elections recently, and a conservative win, I guess, is going to end a bit the uncertainties regarding fiscal policy and institutional kind of instability. I guess Chile is going to outperform. And we also have Brazil election in October 26. I'm still cautious about that, but in a nutshell, quite a lot going on the political side, especially in LATAM. So something to keep in mind.
All right, lots going on the political side. Also, U.S. midterm elections, so keep that on your radar. Zerlina, what is on your 2026 bingo card?
I think this year the Asian market has taken great comfort in the low volatility and good risk-adjusted return of Asia credits. I think next year the technical strength may taper because we have a lot more dollar supply coming from Japan, Middle East, and Australia, as well as local currency bond market continue diverting a lot of fund flow. By surprise to the upside, because we also have a lot of China tech companies rolling out their CAPEX, and they need these. So I think investors need to overcome their home bias, particularly in Asia, and try to diversify across markets and currencies if they to protect the portfolio return.
Great, I love it. All right, Logan, European bingo card. What you got?
Yeah, we've talked a lot about rates today, so I'll stick with that topic. And I think I'll agree with the viewers that with only 1% voting for German bunds, I think not our base case outcome, but I do think that bund yields could trade above treasury yields for the first time in the post-great financial era. That would be my wild card scenario next year.
That's a good one. I really like that. So on my bingo card, I think that we're going to see another record-setting LBO announcement that trumps the EA announcement. I think that bankers are a little bit too jazzed up, so something big is coming down the pipeline. All right, we have made it around the world of credit in about 1 hour. I would love to wrap it up with one more audience question, which is, what do you think is the biggest risk facing markets in the next 12 months? Do we have that reacceleration in global inflation, a labor market unwind / consumer doom loop, AI bubble burst, geopolitical escalations, loss of US institutional credibility, or if you have something else, what's on your bingo card? We'd love to know. You can drop it in the Q&A box now. All right, we will let our audience have some time to vote, and then we're going to wind down our webinar. I love to see that people are still voting after an hour of global strategy conversation. That warms my heart on a Friday that's a bit dreary here in Charlotte. Okay, I think that we have a critical mass. Wow, all over the map again, but top of the heap, the AI bubble may burst. A third of the audience, followed by that labor market unwind consumer doom loop. Perhaps those two things are interrelated. Inflation expectations, not particularly high for this audience, about 18%. And then a laundry list of geopolitical and US institutional credibility concerns are at the bottom of the list. All right, with that, let's conclude our webinar. As always, thank you so much for joining our discussion. We hope to see many of you in person at the upcoming CreditSights conferences. We'd love, of course, to hear directly from our clients. So if you have additional questions, please reach out to us or any of your sales reps. We'll also be following up direct with people who submitted questions that we did not have time to get to on the webinar. And with that, I hope people in the US have a great Thanksgiving and a very happy holiday season. And best of luck to you all in 2026.